Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Thursday, the 19th of January. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about our fireside chat with Mark Carney. He believes that we've entered a world with higher resting interest rates, inflation levels, and thus high volatility in risky assets versus the last 30 years. We then spoke about the needs of having alternative or private assets that has low correlation with the traditional asset classes and with stable cash flows, as well as the ability to transfer the rising cost to the consumers. So now you're going to ask, what are examples of such assets? Well, in our view, infrastructure assets fit the bill very nicely. They are the networks and systems that provide essential services, facilitate economic activity, and enable the movement or storage of goods, water, energy, data, and people. Now, the key points to note about them. First of all, they have high cash flow predictability because regulation provides long-term revenue visibility to infrastructure investments. They are connected with essential services, so they tend to show a lower correlation to the economic cycle versus other sectors. And they are an inflation hedge, because most regulatory frameworks allow regulated assets to use inflation-indexed user tariffs. Now, what are some of the key trends underlying infrastructure assets? Well, climate change must be one of the brightest spots there, helping renewable infrastructure. One of the most staggering statistics that Mark Carney gave was that the world needs to reduce the carbon emissions by 8% every year for the next 20 years in order to achieve the plus 1.5 Celsius temperature target. Well, guess what? In the year 2020, when 1/3 of the global economy was essentially shut down, we only managed to reduce the emission by 7%. Thus, it was mission impossible to rely solely upon changing our lifestyle in order to achieve this goal. There must be heavy investments into infrastructure linked to climate change to allow for more efficient and greener energy. And the size of the investment is estimated to be $3 to 4 trillion per year globally. Now, looking at the potential investment returns and statistics, our testing shows that over a 20-year horizon, private infrastructure has very low correlation to bonds and equities at 0.31 and 0.06 respectively. Backtesting shows that a 10% allocation of the portfolio to private infrastructure may improve the portfolio Sharpe ratio by 20% versus a traditional 60-40 equities and bonds portfolio. Now, of course, there's no free lunch, and private infrastructure is not risk-free. For example, governments tend to maintain certain control or regulation over them, which may impact investment returns. Also, in greenfield projects, there could be construction risk, where project overruns and delays may hurt returns. And finally, they can be exposed to interest rate volatility or refinancing risk, depending upon the level of leverage and the debt structure. That is all from me for today. Due to the upcoming Chinese New Year holidays, Cut to the Chase will resume on Wednesday, the 25th of January. This Friday, though, we will still have our Through the Noise podcast. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.